Good morning.
Good morning, Patricia.
Good morning. Welcome to the investment meeting of the Teachers Retirement Board for May 16th, 2026. Start by calling the roll. Joseph Borelli. Thomas Brown.
Here, good morning.
Gregory Faulkner. Nadia Kazulian. Victoria Lake.
Present. Good morning.
Christina McGrath.
Good morning, Patricia. Present.
Armand Kadir.
Present. Good morning.
Good morning. Amy Slattery.
Present. And good morning.
Morning. We have a quorum. I'll turn it over
Thank
to
you,
the chair.
Thank you, and welcome everybody, and especially welcome to Armor. As a new trustee, welcome to the Teachers Retirement Systems Board. Thank you. It's a pleasure having you. Thank you. And with that, we'll start with the public agenda, passport funds, the March passport funds flash report. And I think Amanda's going to take that from GSAM.
Cool. Okay. So I'm going to start things off with an update of the passport funds through the end of the first quarter. And looking at the first quarter, it was kind of a tale of two pretty distinct periods, January and February being largely a continuation of the strong market results we saw in 2025. There was certainly some geopolitical tensions building in terms of the capture of the Venezuelan president, of some of the European tensions around tariffs and US posturing around Greenland. But really through the end of February, we still were in positive territory. We saw a real flip at the end of February with the initiation of the conflict in Iran. And so the month of March entirely wiped out any of the gains from the first 2 months of the year. So looking at the results here through the end of March, we are looking at negative territory for both the month and the 3-month period or year-to-date period so far in 2026. And in terms of the conflict that we saw in Iran, the biggest impacts being the surge in energy prices triggered a global equity sell-off, which was certainly more pronounced in European and Asian markets. So you do see here, looking at the results within the diversified equity fund, the strongest underperformance coming from the international equity composite within that blended pool, down over 11% for the month of March. Although you can tell, international equities were doing quite well at the beginning of the year. So even being down 11% for March, still down only about 2% year to date through March. The balanced fund being your most conservative option here, 70% in short-term fixed income, was the best performer for the month of March at down only 2.5% and down just 50 basis points for the year as the most conservative option. With that negative performance, not surprisingly, assets for the variable funds were somewhat down, ending the month of March. So you're at 22.3 billion, which was a reduction from 23.6 billion at the end of the year. If there aren't any questions on March, I'll flip over to our April benchmark update.
Questions for Amanda for the March report? Ready. Now I'm looking forward to the April. That's it. I hope, right?
And here we have some nicer numbers and some better news. So we get the bad news out of the way first, right? And then share some better numbers. So by the beginning of April, we did have a ceasefire, a tentative ceasefire at least, and markets rebounded incredibly strongly as a result. And so while there hasn't been a formal resolution of the conflict, it is still ongoing. Markets have responded very positively, both to the sort of easing of tensions, but also the broader macro environment has remained strong. So strong corporate earnings, Outside of the energy spike, inflation has remained relatively stable, and so you have seen the major central banks all taking a sort of wait and see approach and remaining steady. So the S&P 500 was up over 10% for the month of April. That was the strongest 1 month return for that index since 2020. Emerging markets as well had a banner month, up close to 15% in the month of April. And so really across US and non-US markets, very strong, mostly double-digit returns for April. The bond component of the balance fund being the laggard here for the month, just of about 20 basis points for April.
Thank you, Amanda.
Sure.
Any questions? Thank you. So we move on to the public agenda pension fund, and we're going to have a preliminary performance update. Hey, Dan, how are you?
Well, you mean the table or?
You can sit at the table.
Okay, great.
I believe, yeah, sure. Okay. So first we have the preliminary and then the market.
Yeah, okay, we'll run for that. That'd be great.
Great. Thank you.
Absolutely. All right, found my notes are a lot over here. Okay, so great. Continuing along Amanda's theme there. This gives you, as before, benchmark returns through Monday, the 11th, and indicative returns of what the portfolio would have done. As you can see in May, markets continued their upward trajectory, again, reflexive of solid earnings season and just generally, pretty good economic conditions throughout, which we'll get into a little bit in the next part of the presentation. I'll make a quick note here. Again, just since we're now presenting this in public, these preliminary returns are, just so everybody understands how they're constructed. We're still on a monthly audit cycle for the teachers' portfolio. And through our conversion to our new contract with State Street, they perform a daily close, which gives us more confidence in those daily numbers. However, the downstream impacts, testing the performance composites and things like that, still takes a bit of time. We're working to kind of reduce that cycle and give you more timely audited numbers. But for now, and probably for the next several months, we're still giving you preliminary returns based on our observation of your daily returns since the most recent audited numbers, which in this case were March. So we simply have a program. It's actually a spreadsheet that assesses the daily return for the teacher's portfolio at whole, and we string those days together to tack on to the most recent audited numbers, and that's how we arrive at these that you have here, right? In there's a bit of timing difference for when private equity marks come in and are recognized for a particular accounting period, those sorts of things. So they will still move around a little bit if we were to compare month end to month end. But an audited month end to what I would show as a preliminary month end, but it's orders of magnitude and as an indicative measure. This is what we've been doing in the past, and we have some confidence in the number. So I could get a little bit into some of the control checks that we perform to get comfortable with them, but that's the idea. So,
Thank you.
yeah. So at any rate, nice results. You can see emerging markets, particularly strong performer, particularly for this fiscal year. Again, a bit of a function. We'll talk about that in a few minutes of a weakening U.S. dollar, which provides a tailwind for those. We've mentioned that in the past. But if we were sitting here at the end of March, I wouldn't have guessed that this would be our outcome thus far. So good news. We do, yeah. And as we can say, I know last time I spoke before this body, it was the beginning of April or second week of April, and my message then was what a difference a couple of days can make. From the March lows to a pretty strong rebound in early April. It's great to see that this is continuing, but as we'll talk about in a few minutes, there certainly are headwinds.
Yeah.
Mr. Chairman, if I may add,
Sure.
this isn't a return number. It's just based on asset values at NAV. Over that 6 weeks, the funds gained about $7 billion. So the percentages may seem modest, but it's a lot of money.
Yeah. Sure.
And we're up for the year. calendar year, that is.
Good. Are there any questions on material? Or great, then we move to the market commentary. Okay, great. Okay, these familiar slides, and I'll tell you, I'm hoping to retool these kind of soon because our conversation. It's nice to have degrees of freedom when we're kind of talking through to rotate into other markets and things like that. But this would be for a refresh and coming attractions. In the next few months, I'd like to update this a little bit and kind of tune in a little more to at least the topics that we tend to lean into during these conversations. But let's start with GDP print. So since we last spoke, we printed a new GDP number for the first quarter of 26. The annualized rate is 2%, so that's a quarterly observation, simply on an annual basis, which is up significantly from the December mark of 0.5%. Again, back in December, we were kind of continuing. It's one of the weakest quarters that we saw since 2022. It was indicative of kind of softer consumer spending in the period. There's some weaker residential investment, which was a headwind, and then there were some lingering effects from the fiscal disruptions from the government shutdown earlier in the year. The growth rebounded, of course, in the first quarter, driven by stronger government spending. We had some export growth, and then, of course, the animal driving a lot of our growth is fixed investment, particularly AI related spending. That capital expenditure is a huge force that's driving economic growth. As we go down through here again, U.S. tends to lead our developed partners. China, of course, has a slightly different dynamic there. They're obviously an export and industrial driven economy that has a different baseline growth rate, if you will. But if you compare, our experience to UK and Germany, for instance, again, favorable numbers there. A bit of a mismatch in terms of timing, but we are robust relative to our peers there. As we move down to inflation. So again, on Monday we saw the annual CPI, the latest CPI number for April come in at 3.8%. It's a little ahead of the consensus of 3.7%, and higher than the March number of 3.3%, of course. As you might have guessed, of course, energy prices were the big driver of the numbers, accounting for about 40% of the increase in April. Importantly, though, we're beginning to see the pressures from the energy sector kind of filtering into the broader economy. So the core inflationary components are up as well. You see airline fares, for instance, up 2.3% a month. Food prices were going up a bit higher. And the food, shelter, which is kind of a perennial driver of core inflation, up 0.6%. And consequently, we see the core CPI at 2.8% for April. Again, a little bit ahead of the consensus estimates. More recently, yesterday, we saw the April PPI print, so the producer price index. Again, a different measure. It's the Fed's preferred metric in there, and again, a bit more recent than I was able to put together for this one. I'll give you quick highlights there. The April PPI was a huge surprise to the upside. It came in at 6%, which was well ahead of their expected 4.8% rate for the month. Again, energy was the dominant catalyst here, but we're also witnessing substantial increases across the broader economy. So, for example, there were increases in machinery and equipment wholesaling, chemicals, transportation, and warehousing were up a bit. Industrial inputs were up a bit. The takeaway, and one of the things to kind of remember, the producer price index. Again, they're both made to. They're both supposed to measure increase in prices over time. The producer price index tends to look a little bit upstream in terms of the supply chain, and could be used. I don't want to oversell it, but it could be used as sort of an earlier indicator, right? The indexes have some very important differences in their construction and in the components that they tend to integrate into the numbers. But the PPI measures inflation experienced by businesses and producers earlier in the supply chain, so you could think of it as more timely indicator than the CPI, which is more aimed at the consumer's experience, which would be end user. So again, this significant upside surprise, it could be a canary in the coal, right? we'll see if it's sustained. We'll see how long it lasts and if it continues to surprise to the upside. But certainly a number worth considering. As we move over to the top right of the deck here, or the slide here, we'll just take a quick recap of the employment. Again, these numbers came in last Friday. The employment rate and the labor force participation rates were in line with expectations, 4.3 and 61.8% respectively. The stability, if you look under the hood, it partly reflects a shrinking labor force rather than employment acceleration. So some of the indicators that underline that had softened. You see household employment declining a bit. You see part-time employment for economic reasons have risen sharply. So some of these sub-indices, they're beginning to indicate a bit of stress. We don't know if it's sustained or not, but they're certainly worth paying attention to. We also saw an increase in households holding multiple jobs. Contrasting that, prime age labor force participation still remains near its 30-year high, again, suggesting pretty robust continued labor demand. Looking at the payrolls numbers themselves, so we got non-farm payrolls, 115,000 new jobs created in April, which is a bit ahead of the consensus, 65,000 jobs. Down a bit from March, which came in at 185, as you can see there. Still robust compared to most of the prints that we've seen over the past year. And again, hiring strength there, concentrated as in the past among healthcare. You also see some transportation and warehousing jobs, retail trade, and social assistance jobs created there. So a pretty broad base driving the increase in jobs. And then finally, currency rates. Again, nothing prosaic here. Again, the trend is the dollar has been weakening significantly over the past year. There's ups and downs, but if you look at that 1 year number, particularly among some of the less developed currencies like the real or the peso, again, that really is a tailwind for particularly your emerging markets investments, and we haven't seen those trade up significantly in a number of years. But it's I guess every dog has its day, but we're today is very much a day to be celebrating emerging markets performance. Any questions before we go on to the next slide? Questions? Okay, great. Okay, so as we look into our rates here, again, the story is going to be kind of the same for most of our peers. Japan's kind of off, they have their own nuances to the economy, but referring largely to the US, UK, and the EU. Let's start at home here. Kevin Warsh, of course, was confirmed yesterday as the next chair of the Federal Reserve. I know I'm kind of beating you over the head for several months over this, but again, it's a little bit difficult to categorize ideologically, right? He's seen very much in the past as an inflation hawk. Again, good news for the conditions that we're kind of running into. However, more recently, he's emphasized the productivity benefits from AI. He's been a bit more of a accommodative in terms of rate cuts and encouraging investment in business. So it is an open question as to how he'll prosecute his term as a chair. Markets therefore we're watching whether he's kind of taking this traditional anti-inflation stance. Pardon me. Right, I wasn't a Freudian slip. I was actually just reading the wrong line there. Right, or whether he'll be more accommodative to the business cycle. Today's rate outlook, again, continues this theme of higher for longer, and you're going to see that playing out among our peers as well. So again, just underlining that kind of hot April CPI number and the even hotter PPI number. It may give Chairman Warsh some cover to again keep rates higher for longer. But we've also seen a bit of a shift in policymakers' commentary. Going from, I think when we sat here for December, for instance, we were talking about perhaps two rate cuts throughout the 2026 calendar year, and that's since gone down to one, and now we're kind of priced in at no rate cuts for the year. Very similar for Bank of England and ECB, again driven by increases in energy prices and inflationary pressures. The consensus seems to be shifting more toward a more conservative, higher for longer kind of regime. Several major banks kind of underline that point, expect rate cuts more into 2027. Goldman Sure our colleagues here have read this. The first rate cut probably no sooner than 2026. That's consensus from their economists. Bank of America, same thing, no cuts until 2027. And then you see commentary also shifting among Fed officials, acknowledging that rate hikes may again become necessary. So hikes, not just a lack of cuts, but hikes may become necessary if inflation expectations become unmoored. So again, a lot going on there, but you really can see inflationary pressures starting to move into the policy realm and start to impact broader markets. As we kind of move down to the yield curve again, nothing new to mention here. The curve is healthy. It has healthy base rates. It's positively sloping. The 210 spread, which we like to look at as a kind of an indicator of term premium and the normal functioning of treasury yields, is at 46 basis points. You like to see that around 50 basis points. So again, good news there. No signs of undue stress, from market perspective in treasuries. If we move over to the spreads themselves, again, we're looking at the corporate and high yield spreads there. They remain near their 30-year tights. And again, a good indicator that money's flowing freely into those spaces and investors are risk on. They haven't begun to price inflationary concerns or recessionary concerns into their investment theses yet. Even when you start to see, there's some headlines, of course, of default risk, in the alternative credit space. We're not seeing it here. And again, it's an indicator that the contagion effect, at least, is limited. We sort of talked about the spreads again, about where they were last year, 46 basis points. Again, these higher base rates are sort of translating into your 30-year fixed mortgage rates. We saw them dip down as low as 6.25% earlier this year. They're now back up at 6.43. Again, down pretty healthily from a year ago. You'd like to see those around 5.5%, but again, given the housing crunches and things like that, the fact that capital is expensive there helps to keep prices down in that space as well. So again, there's a bit of give and take there. Gold, again, off of its recent high north of $5,000, but still up significantly. Again, an indicator it's being used increasingly as a store of value and as a hedge, and still fairly hot commodity, to pardon the expression. Any questions on the chair? Very good. Great. Thank you very much.
Thank you. And with that, I think we come to the conclusion of our public session. We'll go into executive session. Is there a second? Any discussion, questions? All those in favor of going into executive session, say aye.
Aye.
Opposed, say nay. We're now in executive session. Thank you. Thank you. We're back in public session, and we're going to have a readout from Priscilla.
In the executive session of the passport funds, there were 2 manager updates. In the executive session of the pension fund, there were 2 presentations on the real estate asset class. 2 consensus was reached on both. This was followed by a presentation on public equity. Consensus was reached. The board also had heard a presentation for notice of search for equity index products. Consensus was reached. That being said, details to be made available on further notice. Thank you.
Thanks, Priscilla.
Sorry
Appreciate
about
it.
that. Sorry for the technicals.
No questions. Are there any other questions? Brings us to the end of our public agenda, and thank you, as always, to Janice, our TRS Tech. Thank you very much. And to Will, our recorder, much appreciated. And with that, is there a motion to adjourn? It's been moved. Is there a second? Any discussion? All those in favor of adjourning, please say aye. Aye. Those opposed say nay. Great, we are adjourned. Thank you, everybody.